I'm John Batchelor. This is the John Batchelor Show. Mary Kissel of the Wall Street Journal is here with me. We're going to talk banks, but we're going to start with a news item late in the day. It was breaking news at the Journal site, and it isn't entirely absorbed yet. So I want to try it with Mary and see if this is part of the general theme of what's wrong with the American economy and the global economy. Gap Incorporated plans to shut more than a fifth of its Gap stores in North America over the next 2 years. A come down for the struggling retailer, stark symbol of the way the tepid recovery and rise of online shopping have altered the landscape at shopping malls. This also means, of course, Mary, that the malls are going to struggle because they're losing a good customer, and the malls were never in great shape. I think this represents a hesitation on the part of the consumer, not just offline, but that the shoppers are not out there.
Yeah, but John, it's hard to differentiate between the effect of the consumer that doesn't want to spend and the fact that Gap has just been a really poorly run company for many, many, many years. It's junk. It's junk. I mean, come on.
Mary's looking down her nose at Gap.
Okay, I'm not looking down. No, it's junk bond status. Their bonds are junk.
My
bonds.
concern
Their
is...
finances are junk. That's what I'm
first,
saying.
My first concern, this is a whole lot of people out of work.
Oh, yeah.
That's what happens when borders went out. That's what happened when all of the Circuit City, all of those failures is a lot.
Right.
Those are a lot of retail jobs, and we'll see that in the jobs.
Right, and it's hard for those guys to get reemployed as well.
And that means that all the services that attach to those stores are going to be hurt.
That's right.
And the shippers, and it cuts down on venues for the manufacturers to get their goods in.
That's right.
Store.
And guess where they're going to expand, John? I'll give you one guess.
All right.
Come on, take a guess.
Who's going to expand?
Gap. Where Gap is cutting in the United States,
well,
but they're expanding somewhere else. Where are they expanding? Where are they expanding?
All right, China.
Oh, there you go. That's right.
Off to China. Mary, I do not understand Chinese banking. It looks to me, if I were reading this report for the first time, that there's something not right here. That the state banking services should not be bailing out their own banks by using the sovereign debt fund to buy bank shares that are plunging. What's wrong with this picture, Mary?
Yeah, John, this is just a big cover-up. And you know what? We've seen this before. This is not the first time that the Chinese state has stepped in to bail out its state-run banks. Look, China had a huge, huge stimulus in 2008, 2009. The banks funneled a lot of money into a lot of bad projects. And then the government put the brakes on. And unfortunately, a lot of those loans went bad. And the government says, well, you know what? We want to demonstrate to the world that, well, we're really not going to tell you what's going on. We're just going to give them some money.
I've been told by reporters from the South China Morning Post that in parts of China, there are whole developments that look exactly like Swiss villages. And there are other places that are enormous recreations of financial centers just out in the middle of nowhere, just without anybody in them, just waiting to be occupied by the global growth of financial markets. Not a whole lot in the middle of China. It seems fantastic, Mary, but that was the stimulus package of 2008, 2009, right? Those are the bad loans.
Yeah, well, there was a huge boom in the property market. The other problem that China has is that they basically have two banking systems. They have a state-run system that funnels really cheap money into the state-owned enterprises. And then on the other hand, they have trust companies and this sort of black market of lending that operate on a market basis and give loans on a market rate to the private companies. And so now you have all these pressures on Chinese companies. You have a reduction in global demand. You have rising inflation. And the private companies are getting squeezed. And the state-owned enterprises aren't very efficient. And so you get a lot of bad loans and you get a slowdown.
We have a slowdown and we have trouble in Chinese banking. But the story all week, Mary, and you saw this at the Journal, was the European banks. I do not end the evening tonight with a punch at the European banks, but I have anecdotal information from a number of people this week. You know their names. Francesco Guerrero of your paper, for example, or John Taylor of the Hoover Institution, or Joseph Bruce Wells of Bloomberg, to say that this European banking crisis, the trouble with Greece, the sovereign debt, the pigs, all of that is not a story that's anywhere near completion. That we're just in this drifting period where there are no answers and there are lots of doubts, especially about the exposure of our banks to the European banks that are rotten, the possibility of a cascade in Europe like 2008. Do you credit that scale of threat, Mary?
Well, sure, John, because it's not just the primary lending of U.S. banks. It's, if a bank lends to a company that has significant business in Europe or banking relationships in Europe, there's a secondary effect there, and it's very hard to quantify that. Now, that being said, John, on a good note, U.S. banks are much better capitalized today than they were back in 2008. They wrote down the value of a lot of those bad mortgage-backed securities and other assets that they had on their books. They've conserved a lot of cash. They have really ramped up, tightened their credit standards for things like new mortgages. Not a lot of those, but when they do it, there are higher standards for doing it. So if you're going to have a crisis, I think the U.S. banking system is far more prepared today than it was a couple of years ago.
And still, I'm given numbers that are so vastly out of focus, the possibility of exposure. This is from Goldman Sachs banking analyst, of anywhere between 150 billion, that's the low number, and several hundred, 500, 600 billion exposure. Nobody knows what that number is. And that, I'm told, is why people hesitate to invest in our banks, because we don't know how bad it could come.
Yeah, but you have to ask the question, which banks, John? And the secondary question is, what is the concentration of risk in those banks that you're talking about? I think when people talk about U.S. exposure to Europe, they're talking about Wall Street's exposure to Europe.
Right.
And again, one of the bad effects of the aftermath of the financial crisis and TARP and all of the regulation we poured on these banks is that they have consolidated at the top, and so we are left with bigger banking institutions on Wall Street that may have more exposure to Europe, even though they're better capitalized, than, say, the thousands of community banks that are across America and doing all the lending to our small and medium-sized enterprises. So I think, it's easy to lump these guys into the same basket, but they're not the same kind of banks.
All right. Cassandra's sticking a sword in my back, so I have to give you another try here, all right? All right, here we go.
Okay.
The Europeans have a solution, which is a form of quantitative easing, a huge TARP-like fund, a big loan guarantee to all the banks and getting in trouble when the cascade stops and the failure. But that quantitative easing, I'm told, will spread to America and will lead Ben Bernanke for another round of QE3. That will weaken our dollar, and it will not strengthen our economy. Do you account for that?
I really don't see how Bernanke can do QE3. QE1, QE2 did very little and distorted so much of our savings and investment behavior in this country. I think you'd have a very, very hard time getting that passed. And remember, John, they were talking about taking other measures, and you had 3 Federal Reserve board members
still dissenting.
Yes. So, the idea that we would have QE3 here, I think, is far-fetched.
The jobs numbers are not going to get better for a year. We're told this by the analysts. Ben Bernanke believes that it's his job to employ America. So you're saying right now, middle of October, QE3 not going to happen.
Not going to happen. And John, it was always farcical to think that you can change an interest rate and create jobs. You have to create a business environment where businesses can take risks and grow and employ more people.
Mary Kissel of the editorial page of the Wall Street Journal. We're going to look to Sidlindra. We're especially going to look to the presidential campaign for the Republicans, where Herman Cain, leading all of the significant polls, very close with Mitt Romney. But in any event, who is Herman Cain, and what organization has he put together to capture the imagination of the Republican Party? Mary Kissel of the editorial page. I'm John Batchelor. This is The John Batchelor Show.